All right, today we're going to pull back the curtain on a core investing concept, fundamental analysis. This is how the pros look right through all the market noise to figure out what a company is truly worth. So, how on earth do they do it? Well, let's dive in. So, let's kick things off with a classic question. You see a stock trading for $100 and another for $10. Is the $100 stock automatically more expensive? Now, you might think you know the answer, but it's not quite that simple. And honestly, understanding why is the whole key to fundamental analysis. Stick with me, and we'll have a crystal clear answer by the end. So here's our game plan. We're going to start with the absolute bedrock idea, price versus value. Then we'll walk through the exact framework that analysts use. It's called top-down, starting with the whole economy, then narrowing it down to an industry, and finally zeroing in on a single company before we figure out how to put a price tag on it. Okay, first things first, we have to get this one idea straight because it's the foundation for everything else. It's the huge difference between a stock's price and its actual value. Think of it this way. Price is the sticker on the car, but value is what's really going on under the hood. And those two things, they're often very, very different. And this right here just lays it all out. The market price, that's a fact. You can look it up in 2 seconds. But it gets pushed around by emotions, by hype, by fear. It's volatile. Intrinsic value, on the other hand, is an educated opinion. It's what you get when you do the actual homework, when you analytically calculate a company's health and its future. Right. And here's the belief that drives this whole thing. Eventually, a stock's market price will move toward its real intrinsic value. So what does that mean? It means if you can figure out that value today, you're playing with a serious edge. That's how you spot a bargain before everyone else jumps on board. It all boils down to this one simple idea. The job of an analyst isn't to just react to the price they see on the screen, it's to build a strong, evidence-based opinion on what a company is genuinely worth. Okay, so how do they actually build that opinion? It's not just a gut feeling. There's a method to the madness. They use a very structured, top-down approach. You can literally think of it like a giant funnel, used to sift through thousands of companies to find just a handful of the most promising ones. And this is it, the EIC, or top-down framework. See the logic? You start with the widest possible view, the economy. Then you narrow your search to a promising industry within that economy. And finally, you zoom all the way in to find the best company in that specific space. So let's see how it works, starting right at the top. First up, the macro view. The overall economy is kind of like the ocean tide. It can either lift all the boats or leave them stuck in the mud. Even an amazing company will have a tough time if the whole economy is sinking. So analysts always start by getting a feel for the environment. And these are the big dials they're watching. Is GDP growing? That means people and businesses have more money to spend. What about interest rates? If they're rising, it gets more expensive for companies to borrow and grow. You see, a healthy economic backdrop just makes it so much easier for good companies to shine. Now, here's a point that really messes with people's heads. The stock market is not a rearview mirror showing you what just happened. It's more like a windshield. It's what's known as a leading indicator, meaning it's always trying to guess what the economy will look like 6, maybe even 12 months from now. Okay, so once an analyst has a decent handle on the economy, it's time to narrow that funnel down. We move to the next level, industry. Because, let's be honest, not all industries are created equal. Some do great when the economy is booming, others are way more stable when things get rocky. The goal here is to find the right wave and ride it. Another thing they look at is where an industry is in its life cycle. Is it brand new in that exciting high-growth phase with huge profit potential, or is it a mature industry where growth is slowing down and everybody's fighting for a piece of the pie? Answering that question helps set some realistic expectations. And here we are at the very bottom of the funnel, the company itself. We've found a healthy economic climate, we've identified a promising industry. Now, the final task is to pick the absolute best horse in that race. But, and this is a huge but, finding a fantastic company is not the finish line. You could find the most amazing business in the world, but if its stock is already priced for absolute perfection, it could be a terrible investment. This goes right back to that core idea. It's all about the value you get for the price you pay. So this is where the real work begins. Analysts roll up their sleeves, they dive deep into financial statements to really understand the numbers. They use tools like a SWOT analysis to size up a company's position, its strengths and weaknesses versus the opportunities and threats it's facing out there. And now for the grand finale. This is where everything we've done comes together. After all that analysis of the economy, the industry, and the company, it's finally time to answer the million-dollar question. What is this business actually worth? How do we calculate that intrinsic value? Now, there are a ton of tools for this, but one of the most common ones you'll hear about is the price-to-earnings ratio, or PE ratio. It's actually a pretty simple metric that tells you how much investors are willing to pay for every single dollar of a company's profit. Let's make this real with a quick example. Okay, let's say a stock is trading at a nice round $100 per share. And we've done our homework. We've looked at the financials, and we see that the company earns $5 for every single share out there. That's its earnings per share, or EPS. So you just divide the price by the earnings. 100 divided by 5 gives us a PE ratio of 20. So what does that number actually mean? In plain English, it means that for every $1 this company makes in profit, investors are willing to pay $20 to own a piece of it. All right, that was a whirlwind tour through the analyst's playbook. So let's boil all of this down into the key things you absolutely need to remember. First and most importantly, never confuse price with value. Price is what you pay, value is what you get. Second, use that EIC framework, economy, industry, company, to give your research some logic and structure. And remember that valuation is both an art and a science. It's about forming a solid, educated opinion. Which finally brings us back to our first question. A $100 stock with a PE of 20 is actually seen as cheaper by the market than a $10 stock with a PE of 75. See? It's never just about the price tag. You know, this top-down framework is such a powerful way to look at any business. It shifts your focus from just being a price watcher to becoming a true business analyst. So the only question left is, what's the first company you're going to analyze?